All right, how's it going, friends and family? Dude, it's absolutely freezing here in Japan. It's hovering between like 21 to 28 degrees Fahrenheit. Freezing. But believe it or not, it's another big week in the stock market, and here are the big call-outs. And by the way, this is going to be a laid-back environment. It would behoove you to treat it like a podcast, okay? Number one, we've got the AI data center players reporting, including Cisco, Arista, Vertiv, and Applied Materials. I think ASML and Lam Research, they also reported previously and they crushed. So if I had to make an educated guess, I'm going to go ahead and assume that Applied Materials is going to follow suit, because those are the three picks and shovels in the AI infrastructure race. They're the ones who sell the equipment to manufacture the semiconductor chips. And I think with how much the Mag 7 is spending on CapEx, these guys should benefit from it. I could absolutely be wrong, but it kind of makes sense, right? The math should add up. Also this week, we have two burger joints. We got McDonald's on Wednesday, and then we have Wendy's on Friday. And out of the food CPG stocks, we also have Kraft Heinz. In my opinion, it's arguably the worst one in that category. Even Berkshire Hathaway, I know for a fact they regret investing into Kraft Heinz. And then we also have some fintech players like Shopify, Fiserv, Toast, Coinbase, and Robinhood. Speaking of Robinhood, dude, I was taking a look at them prior to filming. Man, year to date, or I guess if you zoom back like 2-3 months, they've just been crashing in their stock price. It's kind of weird to see, because in 2025, I feel like they were one of the more beloved darlings. And obviously, there's some other pretty big names that are reporting, such as Ford. They just made the big transition and pivot from EV vehicles. Instead, they're trying to become a battery and power producer for the data center movement. Their stock price has been exploding. Consequently, there's also CVS, Spotify, Coca-Cola, and of course, Lyft. Dude, I don't know why you would ever want to pick Lyft over Uber when it comes to the rideshare businesses to invest into, but I don't know, put me on. And there's also Rivian. They're doubling down in the EV game, with Tesla making an exit with the Model S and X. I think Rivian should take up some more market share, but I'm not really particularly bullish about Rivian. As a matter of fact, we can even toss in everybody in the EV space. I'm not really bullish about car manufacturing, which is why when Ford made that pivot into powering up the data centers, the stock market loved it. But, of course, there's much more than the ones that I just called out, because each day of the week, there's going to be hundreds of stocks that are reporting. So now we're going to be taking a closer look at each day of the week, and I'll be giving you some commentary and add some color to some of the names that you should be looking out for. But before we do, can I just circle back and talk about last week? My goodness gracious, was last week so crazy. Like, when it comes to speculative, hyped-up stocks that may or may not be profitable, I'm okay with seeing them drop 20-30% after an atrocious earnings. Actually, let's take a step back. If you're not in the know about what the earnings are, it's essentially when a publicly traded company gives us a financial snapshot of how things are going, but also the roadmap and guidance for the future. And they do this every 90 days, or I guess every 3 months. And if you're invested into a company that's reporting their earnings, or if it's a company that you've been eyeballing for a while, I've personally have found that the earnings week is a really good opportunity to either jump in or jump out, because the stock market, they tend to be very emotional. Like, if they say something that's kind of rough, it's not unusual to see them go on discount like 10-20% right off the bat, and then before the day closes, they recover and they're only down -7%. So, me personally, I like tuning into the earnings. That way I can make sure that my investing thesis is still sound and coherent with each of the holdings that are in my portfolio. But, as I was saying, unprofitable stocks, 20, 30, 40% into the red after they post horrifying earnings, I don't mind. But when it comes to the Mag 7, dude, I was so shocked. You would not think that could happen to Microsoft and Amazon. But it did, right? And I just uploaded a video, my level-headed take and perspective on the Amazon sell-off. You should go listen to it because I think I give a rebuttal to why everyone says it's all over for Amazon. And the reason why Microsoft and Amazon are both selling off, it's because of CapEx. Capital expenditures are the money that a company spends on physical infrastructure like manufacturing equipment, robotics, facilities, factories to produce XYZ to further their growth story in the future. But like I always say on this channel, I think Wall Street, they just tend to be so short-sighted, right? They're all about profits and gains in the short term while neglecting the long horizon. Because my whole thing is like CapEx, it makes sense to a certain degree when the person in question is Microsoft, when the company in question is Amazon. They're not doing CapEx to be cute. They're doing CapEx in order to further increase their economic mode and to be fully vertically integrated in the AI movement in data centers and in the cloud. So when the stock market punishes them, I'm like, y'all are so short-sighted. But it's not just Microsoft and Amazon, right? I think last week we also saw AMD and Palantir. They got hammered beyond belief. I was actually taken aback. I was watching Palantir drop and I was like, geez, man, that's pretty horrifying. So I think the market, they're pretty emotional to say the least. This is, we're walking in really weird territory where even the highest quality Mag 7 caliber stocks like NVIDIA, AMD, it's not out of the blue to see them drop by 10-15% on a single trading day while keeping in mind their market cap is over $1 trillion. So yeah, it's pretty wild. Which, I gotta say this, okay, it's a perfect time for me to convey this. The stock market, it's one of the few places on earth where when things go on discount or clearance, like a really good quality company, people run out of the store and say, absolutely not. You know what? I was eyeballing Microsoft at 500, but now that they dropped down to 390, I want nothing to do with it, right? And I think that mentality is just absolutely hilarious because people will complain everything is too expensive, and then when the stocks have a correction and they finally fall and drop down in evaluation, they give another excuse to sit on the sidelines. It's like a never-ending battle of excuses. I don't know. I think it's pretty funny stuff. Now, with that said, let's go ahead and kick things off by talking about what's going to happen on Monday. All right, to kick things off on Monday, I just uploaded a video about Nutex. It's a very small community-based hospital system that's crushing it right now. And I say that because BDX, they're in the business of manufacturing and selling hospital supplies like syringes, needles, all that to say, I'm really bullish when it comes to hospital equipment like the ultrasound machines or even the people that are manufacturing artificial hearts like Medtronic, Edwards Life Sciences, anybody that's in that territory, I'm super bullish. As a matter of fact, right before my first daughter was born in October, I was looking left and right in the hospital room because if you've been there before, you know exactly what I'm talking about. You're going to be sleep deprived. You're going to be bored out of your mind, but you're also going to be anxious. You're also going to be cleaning a newborn's diaper that, by the way, no one told me that when they first take a dump in the first 72 hours of life, it's called meconium, and it's like black tar. I always thought like a baby's fecal matter would be like a normal poop, but dude, that thing was like straight up black Elmer's glue, and it was really nasty, but it had no odor, right? But anyways, besides like diaper duties and feeding the baby, I was also taking a look at what's around this room. Right, just for fun. So, funny story, I did buy into them right after she was born, and then I sold right out of them when they had their little rebound. So BDX is a company that I'm always going to be constantly monitoring because I think it's a pretty high quality company, and I would argue like 7 out of the 10 things in the hospital room, because we were there for 3.5, I think it was like 4 days. We had a very complicated birth story. But that's neither here or there. And BDX manufactured a lot of the stuff that was connected to my wife. High quality. I like this company. So that's first up on Monday. And let's see if there's anything else that we can... let's see. Cincinnati Financial. Principal. By the way, how are you doing? And I found out that's a very American thing to do, right? Other cultures, especially like here in Japan, nobody gives a rat's ass how your day is going. Nobody cares, right? You just go about your day, your day to day, or you get seated down at a restaurant. Nobody cares about you. They'll just say the usual greetings like konnichiwa. Nobody cares about, like, how are you, like, Americans. And apparently that's, like, a very stereotypical thing about Americans. Like, we are friendly, and we actually care. I mean, obviously there's some people where it's just robotic. Like, how you doing? Good. How are you? Same. Like, it ends right there. But I'm a part of the demographic that genuinely cares about how other people are doing. So when I ask, and when people give me just, like, that one-word answer, I get kind of let down. Because I actually... because I've been there before, right? Like when someone's going through a pretty rough time and they're turning into kind of like a hermit crab and they don't want to talk to anyone else, you don't know if you're going to be that person that allows that individual to vent, or a lifeline, or what have you, right? Now, I'm not trying to say that I want the individual to trauma dump on me and just talk about what happened to them when they were a kid. I'm not talking about that. I'm talking about, like, man, if their day's going rough and I can do something to help them out and it doesn't cost anything and they're not asking me to join a cult, dude, I'm willing to do it. I'm down, right? But anyways, yeah. By the way, in Japan... when you get seated down or you enter into a store, they'll literally just say the phrase, irashaimase, like welcome. Other than that, it's like they truly do not care. And if you go up to them and try to strike up a conversation, it's actually rude. Like, you're not supposed to do that. It's a cultural thing. After living here for almost 4 years, I'm still kind of not used to it, right? Because in the U.S., you're used to like a friendly server, friendly people everywhere. But I will say this, some of the most rude, arrogant, and hateful people I've ever encountered and met in my life were in the South. I don't know why that is, because I know there's a whole narrative that Southern hospitality is a thing. But dude, I lived in Alabama, I lived in Georgia, I lived in Mississippi, I lived in Texas. Yeah, right? But when we talk about the mountain folk in Virginia, near the Shenandoah Mountains, like Roanoke, Lynchburg, West Virginia. We talk about the folks out near Washington and Nevada, super friendly. Just my personal experience, right? Anyways, I'll stop doing that. Because I know some of you are probably getting really annoyed, like, dude, what are you doing? I thought this was a video about the companies reporting their earnings this week, dude. Anyways, let's talk about Monday.com. This is a company that's just been getting absolutely battered, obviously because of the software sell-off. To be honest with you, I don't see the bottom anywhere near for them. I think they're just going to keep falling until there comes like a growth catalyst in that, like, okay, well, it turns out Monday's now going to pivot into doing this, something else. Because as a guy that uses, I used to use it, Monday.com, like that was the standardized a project management tool that we used across the board, especially for my org and team in corporate America. Since then, I have not used it, and I found out that there's so many better alternatives like Trello, Asana. So when I think about Monday.com, I'm not particularly bullish. I feel like out of the entire software stock sell-off, this is one that I'm kind of fearful for. Same with their cousin, Atlassian. It's like the exact same feelings, no economic moat, and their software, to be honest with you, it seems as if Anthropic can make what they're doing at a cheaper price, and I just don't see why a company would want to stick around with Atlassian. So those are the two that I would not even want to consider as the software stocks continue to sell off. Monday.com and Atlassian are no bueno in my opinion. Obviously, I could be wrong, but it's just what I think. Is there anything? Prospect Capital. I'm pretty sure that's a BDC. Could be wrong. Let me see. Yeah, it's a BDC. Specializes in middle market. I want to see how juicy their dividend is. 20% dividend yield. But what is not so juicy is they're going to get delisted if they drop down to like 5 cents a share, which seems like that's the trend they're going in, right? That's pretty horrific. Negative 82% share price appreciation, total return. Yeah. Anyways, let's move on to Tuesday because I don't really like looking at anything below like a $1 billion market cap. But before we do, I wanted to comment on this. Hain Celestial Group. I personally have now exited out of all of my food CPG stocks. But if I had to invest into one and the numbers looked good, and like obviously I do not know if their numbers look good or not, but based on their products, they're in the business of making and selling everything organic and natural snacks. You know, like the bougie snacks that you see in the snacks aisle? This is the parent company for them. Oh yeah, it says it right there. Sells organic and natural products. But on second, oh my gosh, what is going... No, I would not want to invest into them. What in the hemoglobin is this? For the past 10 years, their revenue's just been dropping. Okay, I take back what I said. That's why I'm so glad we did a deeper dive together. That was atrocious. I would not invest into them. I was going to say I wouldn't mind investing into them if the fundamentals and numbers looked good because they're in the business of making healthy food. And I feel like that's the trend that seems to be popular with everybody under the age of 40. I feel like the old folks, they're too set in their old ways. You know, the people that are like 70, 80, I don't think they give a rat's ass if it's organic or natural. As long as it tastes good, I think they'll eat it. But for the younger generation, I think healthy and natural is really important. Another company I wanted to highlight before we get to Tuesday is Chegg, because I gave a good, I would argue maybe 90 minutes doing a deep dive into Duolingo on Friday night. And I was like, dude, I feel like what's happening to Duolingo, it's almost disrespectful, right? Because they're executing crazy numbers. And then I always humble myself by looking at what happened to companies that looked just like Duolingo not too long ago, right? Chegg is a perfect example of what I think is going to happen to Duolingo. Now, obviously, some people, you might not want to hear this part, especially if you're investing into Duolingo. Chegg, up until like 2019, they used to have a pretty good TAM, a total addressable market of college students utilizing their services to buy notes, study materials on exams, topics, subjects, like if you were taking algebra, history, biology, whatever it is that you were taking in college, they would hook it up with notes that were specific to that textbook or to that professor. And then we found out their business model got absolutely disrupted with AI. Now, these students, dude, I'm not even joking. If you are a hiring manager in corporate America, you have to test the critical thinking skills of the candidate that's in front of you. These kids that are like 18, 19, 20, they might be smart on paper or on surface value, but because they rely on ChatGPT so much to do all of their critical and reasoning and analytical thinking, they cannot think outside of the box. I'm not exaggerating. So if you're interviewing a candidate and they're under the age of like 25, 26, you have to think of questions that are not so black and white, but tap into putting them on the spot and see if they have what it takes to think critically. All I'm trying to say. So having said that, if you take a look at Chegg, since the rollout of ChatGPT and the other LLMs, dude, they've just been getting cooked, right? And prior to that, they were posting some juicy ass numbers, just like Duolingo. And I think a better example would be Skills. They're in the business of producing mobile games for your Android or iPhone. Off the top of my head, I cannot remember any of the games because this is a company I did a deep dive on in 2019. Yeah, it's 2026. I'm not going to remember the specific titles of the games. But just like Duolingo, at one point, they used to execute, their revenue was going up by 136% year over year, 91% year over year. And then look what happened, right? Bam. It just fell off a cliff. And that's exactly what I think is going to happen to Duolingo. That's why when it comes to investing into stocks, it's so important to ask many questions. But I think one of the first questions, no matter how attractive a stock looks, is do they have an economic moat? And if they do not have an economic moat, it's not worth entertaining. Because given, I don't know, like 5 months or 5 years, they're going to turn into a Chegg or a Skills if you're a Duolingo. However, if they did have an economic moat, obviously my opinion would be a little different, right? But anyways, as we jump into Tuesday, for the rest of the video, I'm going to be focusing on the utilities with a little more care. I mean, the other ones we'll talk about as well, but the utilities are my focus for this week because I just sold out of Dominion Energy after holding on to them since 2019. And it was time. It was time for me to move on because I feel like the ROI wasn't the greatest. So I feel like I like the utility sector, but out of the utilities, I feel like Dominion Energy was probably like a D, maybe even like a D minus. Having said that, there's a lot of high quality utilities and I want to jump back in, right? But not into Dominion because when you think about investing into AI, most of us only think about the chips, right? Like NVIDIA, AMD, or the maker, TSM, or even like the software companies that are utilizing the chips like Meta or Microsoft. But I think there's a lot of value in the infrastructure and the energy that powers the data centers. And that's why I feel so bullish about the utilities, because we just found out from last week, right? Amazon's going to be spending $200 billion on CapEx. Google's doing $185 billion. Microsoft's doing $150 billion. That's a lot of data centers that are going to need power, right? And that's why I'm like, well, hold on. I kind of like the prospects of a utility because they're super safe. It's a regulated monopoly. Usually in their region, they're the only ones that are allowed to provide power. And their dividend profiles, it's basically a proxy for a bond with the upside of share price appreciation. So for me, it's conservative, it's safe, and the risk to reward is super good, especially if you talk about the big dogs like Duke Energy, the Sovereign Company. I don't really like the little ones. I think the little utility companies can be a little risky, but the utility sector's a landscape where, given enough time, they do mergers and acquisitions across the board and consolidate. Just like with what's happening in the oil and energy space, there used to be like, I don't know, 500, 600 companies, and it's slowly turning into 430, 300. Reason being is that to survive, you have to do mergers and acquisitions, especially in mature and established industries like oil and gas and utilities. So maybe it's not the worst idea in the world to go with a regional, smaller player. So let's see. Tuesday, we got Coca-Cola, AstraZeneca. These two right here are pharmaceutical. Coca-Cola, I mean, to be honest with you, it's high quality. I mean, I guess we could talk about them. It's high quality, but I just feel like the ROI is not really, especially like the CAGRs. You know, I think it's really good for like a slow and steady, but I would prefer something that's a little more aggressive. Coca-Cola, I feel like if I had to give them a grade, it would be like a B. It's solid, it's good, but there's definitely better options out here. And let's go back to Tuesday. S&P Global, CVS. Let's take a look at Duke Energy. So Duke is a regulated utility that operates their footprints in Florida and the Carolinas. And I think that's really important because based on my research prior to filming this video, I was watching a documentary about data centers that are sprouting up all over the US. And it's happening in very consolidated areas like Nova, I think Loudoun County and Prince William County, Virginia. There's a lot of data centers over there. There's quite a few in Nevada, in California. But I think instead of just putting all the data centers in one geographic terrain, I think the hyperscalers and other companies, I think they're trying to disperse and spread it around the country. That way they can get favorable rates from the other companies as well, right? And it's not smart to have all of it in one centralized location, because what happens if there's like a power outage? Then your entire network and cloud goes black, right? So I think to spread it out, I think it is a good idea. And I don't know. I like Duke Energy. I just don't like them at their current valuation. What I mean by that is if you take a look at them, they're pretty much at their all-time highs for the past 5 years. Obviously, if there's like a dramatic sell-off after their earnings and they drop down to like $100, maybe even like $95, I'll be interested, right? Because I think it's pretty high quality. And with a utility, we do not look at the free cash flow because there's a lot of CapEx. You have to be constantly renovating, maintaining, and repairing your infrastructure, right? Because if you don't do that, you can cause forest fires. It can cause a power outage. So it's a CapEx heavy industry, which means there's going to be also a lot of debt. So when it comes to the debt to EBITDA ratio, I would even argue to bump it up to like a 4 or a 5 instead of the standardized 3. And that's what we're seeing with Duke. We're seeing a 5.5. I don't think it's that big of a red flag, considering their historical number stays around that 5 number. So the debt situation, I would say, is not too alarming. Now, obviously, if you compare it to something that's asset light, like a software company, obviously their balance sheet looks horrific, but that's not a fair assessment. Each industry and sector has different criteria metrics that you need to prioritize. So I would say with the utility company, I think there's 3 things that I kind of care about. Obviously, there's more. One is their gross sales. I want to see them be consistently making more money than they did the year prior. And then number 2 is their return on equity. I feel like with the utility, the golden standard's at least 10%. And with Duke, I think 9.9% we can round up and give it to them. That's an important metric. I don't want to see where it's like wildly swinging year over year. 2020 is obviously a fluke year because of the pandemic. We'll give them a break on that. So what I mean by that is, like, say sometimes it's 9% and sometimes it's like 2% and it keeps swinging back and forth. That for me would be a red flag, and they're not doing a good job of handling their operations. The third thing that I like to look at is their dividend profile, because it's like a proxy for how they're managing their profits, right? So very important. With utilities, the payout ratio can be as high as 85% for my personal preference. Obviously, with other industries, it can be as high as like 50, maybe 70%. But with a utility, they're operating as a regulated monopoly, and their profit margins are monitored as well. They say like the price to do business is like $1. They can't charge more than XYZ percent. And so I like to see that they're managing their operations so well to the point that their EPS, their dividends per share, and all of that are manageable. Like, I don't want to see a payout ratio that's like 120%, if that makes sense. Because that shows me that they're not handling their operations well, and they're, I guess, reckless with how they handle their capital as well. So with Duke, I mean, the dividend yield is good, 3.5%. What's not so good is the dividend growth rate. I mean, it could be higher, right? That's why I was saying, when it comes to utilities, I look at them the same way that I would look at a bond. Me personally, I would never invest into bonds. I just don't see the value add. I think if I was 75 years old, obviously that would be a different opinion. But with a utility, you get the yield of a bond, but also the prospects of share price appreciation. So that's why I would rather go with a utility than a bond. But that's just me. And something else that I want to call out is not all utility companies are created the same. Because when you think about this one, it's a utility company that services Northern California. Dude, this is a piece of crap. Because not only are they a dividend cutter, I'll show you, right? They used to pay a dividend, and then they had to cut their dividend because they ran into a lot of wildfire issues due to their own equipment burning down and causing fires everywhere. So those are the kind of things that you want to be mindful of. Like, obviously, if I didn't give you that backstory and you just saw this, a 10% payout ratio, 100% dividend growth rate, you'd be like, dude, sign me up. This is a company that's facing a lot of legal battles And rightfully so, because I think those wildfires caused a lot of damage, not only to homes, but to lives as well. So this is a perfect example of a utility that I would not want to go near. Now, having said that, let's go back to Tuesday. Sorry about that, guys. Oh my gosh, what is happening here? Okay, Tuesday, February the 10th. We got Marriott International, Spotify. Now, here's the thing. Like, Spotify, I do like their numbers, right? They're in the business of podcasting and music streaming. What I don't like is I truly do not think they have an economic moat. And I know what I just said right there might trigger some people, because I think with the big tech, I think their flavor and variety is catching up to the point where the value add of Spotify, it doesn't really make sense, right? I think for most people, they would rather just keep it all in-house. Like, yeah, depending on who you are, you might be biased for Amazon products. For other people, it might be like Apple products, like Apple Music, Apple Streaming, Apple Podcasts. I just found out that Apple has a specific classical music app. I downloaded it. It's not bad. And the whole reasoning is that the algorithm for classical music is really different. And I kind of agree, because they've been putting me on some new modern classical music that's pretty nice, because I've been listening to a lot of classical music on repeat, the exact same composers and the exact same pieces from like 400, 500 years ago. But to hear new modern classical music is a nice change of pace. And having said that, there's also YouTube, right? A lot of people use YouTube Music. So what I'm saying is, like, yes, I see the growth story of Spotify, and it looks good. But I genuinely do not think they have an economic moat, right? And because I feel that way, when I take a look at them, even though they're going on a massive sell-off because of the software, I guess, apocalypse, this is a company that I have just no interest in. Now, if you're invested into them, I don't blame you. I mean, the numbers make all the sense in the world, right? I bet you their free cash flow is bonkers because they're not manufacturing anything, right? Their CapEx is non-existent. Yeah, $2.9 billion of free cash flow. Like, the numbers and financials, it makes sense. Like, if I had to pick between Spotify or Atlassian or Monday.com, obviously I would rather go with Spotify. But if you're bullish about music streaming, podcasts, and everything else for the listening experience, I would personally go with Google. Because you get everything with Google, right? Their endeavors in quantum computing, AI, YouTube Music, Google Cloud. So, I don't know. When your entire platform's just tailored for online music streaming and podcasting, I'm like, yeah, but you're not the only one. And outside of the realm of big tech, there's hundreds of tiny little apps that do the same thing that Spotify is trying to do as well, right? Like, man, I can't remember the names because I don't use podcast apps, but like Stitch Fix and some of the other ones. But I guess the differentiator with Spotify, I mean, I don't use it. Obviously, if you can't tell by my language, I'm old school. I use Pandora. Here in Japan, it doesn't work because Pandora only works in North America. But I think with Spotify, they created and cultivated a community of people that make the playlist and they share their playlists. And it's kind of like a social media app. I think that's the best way that I could think of it. And I think they make their money from all of the advertisements that are streaming with the music. So it's kind of like a radio station, investing into a radio station back in like the 1940s, 1950s. So I do see the compelling growth story, but I just don't believe in their future. I know that sounds a little harsh, but there's Ecolab. They're in the business of making like sanitary products for corporate businesses. And they do water treatment. They're in the business of doing a whole bunch of like random crap. I kind of think of them the same way I think of 3M. It's like a very big, mature, established industrial company. I like them, but I'm not really interested in investing into them, right? Because when you take a look at their gross sales, I mean, a 2% year over year right here, 1% year over year, not the greatest, especially with their trading multiple being 41 based on the trailing 12 months EPS. Forward PE being a 35, not interested, right? Dividend profile is okay, but nothing to really move the needle for me to be like, dude, I really need to buy into Ecolab. All else being equal, I would rather buy into Amazon, Google, Meta. I know that sounds so boring, but I mean, they're being sold off right now, and so why would I buy into Ecolab when the Mag 7's on sale, right? So that's just the logic right there. And then there's Cloudflare. Let's see. I do like them. Oh, there's Edwards Life Sciences. They're in the business of making a crap ton of like random accessories and parts for the heart. And I can't say that they have a monopoly because they do have fierce competition from Medtronics and I think one more company. I think I don't know if it's AbbVie or not, but there's one more player that's, maybe it's Johnson & Johnson, their medical devices division. But this is a really good company. I just wish they paid a dividend. I don't think they pay a dividend. Yeah. Let's see. I actually almost joined Edwards Life Sciences. Gosh, what was the role called? It was like the Strategic Leadership Development Program for the MBA. In the final round, I remember I got to meet the other applicants. They were all from Harvard Business School, Stanford Business School, Sloan Business School, which is MIT, and then there was me. And then I was like, dude, there's no way I'm going to get the offer. Because they only had like 1 or 2 spots for that year. Yeah, I didn't get the offer. But I remember networking my balls off to get the interview invite and then getting all the way to the final round. And then come to find out, they just hired the people that are from the same school as them. Most of the folks that work at Edwards, especially like upper management, they're all from Harvard. And I'm not from Harvard, so it is what it is. Datadog, there's Pfizer. Listen, out of all like the fintech space, this is probably the last company that I would consider. For those of you that are thinking this is a good opportunity, dude, I just don't see it. I don't see the logic. I don't think they're going to stop falling, right? It's kind of like the same fate as PayPal. I think when it comes to fintech, it's hard to go wrong with JP Morgan Chase, right? If you're bullish on buy now, pay later, if you're bullish on this or that, it doesn't really matter. JP Morgan Chase, they're integrating it into their ecosystem. So Pfizer, PayPal, XYZ Block, it doesn't matter who it is. I'm not going near them. Like, I get it. Their valuation is stupid cheap, but the reason being is that Wall Street's absolutely bearish about them. And so because the sentiment is so negative surrounding them, I don't want to put my capital into dead money, meaning something that's going to be flat or declining year over year, if that makes sense. So, yeah. WP Carey, it's a pretty big real estate conglomerate company. I think they're headquartered or predominantly in Arizona. It's actually the name for the Arizona State University's business school, WP Carey School of Business. I don't know if this is a REIT or not, though. I've never... Largest net lease REIT. I guess it is a REIT. That means their dividend profile is going to be juicy, 5% dividend yield. Do not look at that. Their payout ratio is not 200%. It's going to be predicated upon their adjusted funds from operations. And as much as I like stockanalysis.com, which by the way, I have a referral link down below that gives you a discount on top of whatever promo they got going on, I prefer allreits.com when it comes to REITs because it's a website that's just focused on REITs. Because Stock Analysis, they report everything on a GAAP basis, and it doesn't make sense to look at a REIT with GAAP principle in numbers, if that makes sense. Like, it really doesn't make sense. It's like you're a football coach and you're trying to recruit a volleyball player and looking at metrics of volleyball. Now, you got to assess what's their 40-yard dash, what's their bench press. You want to look at it from a football lens, right? Because you're going to turn that volleyball player into a football player. With WPC, their REIT score is a 65 out of 100. Looks like their AFFO growth is trash. Their dividend growth is trash. Speaking of which, what is their payout ratio? It's a 75%. So it seems like it's affordable, but what's going on here? It looks like they cut their dividend a little bit back in 2024. It dipped from like $1 down to 85 cents. But after they cut the dividend, now it's back on track to growing year over year. I wonder what their occupancy rate is. Occupancy rate is 97%, but it does seem to be declining downwards year over year. I mean, at one point, it used to be, 99%. Now it's 97%. It's just going on a downward trend. Not really a fan of that. The AFFO, very inconsistent. You can think of that as like the EPS, the earnings per share, or the free cash flow per share in the context of a REIT. And let's see, Hasbro, the toy company. Dude, I don't understand why people feel bullish about Hasbro or Mattel. I really don't get it. And then we have Agree Realty. They're kind of like Realty Income Corporation or NNN. Exact same thing. They lease commercial buildings to a lot of the random like car washes, restaurants, to Marshalls, TJ Maxx. It's high quality. I really like them. My gosh, though, 13% in the past 5 years. But if you bake in the dividends, it should help bridge that gap. 4%. Yeah. Agree Realty, I like. But to be honest with you, I think I'm pretty happy with my Realty Income Corporation holding and waiting. I don't know if I want to add another guy that does the exact same thing that Realty Income does, if that makes sense. Oscar. Now, a fun fact about Oscar Health is that one of the executives or upper management, leadership, whatever, he's the brother or son-in-law to the current president. So I guess there's that, right? Maybe favorable legislative ally in Washington, D.C. for their health insurance endeavors. But based on what we saw last week with the health insurance companies like Molina, Centene, dude, it's an industry that's going to be in a world of hurt for 2026. So it really sucks with my United Health holding. I wish, kind of in hindsight, I probably should have sold out of them when they hit like 365 last year. Gosh, but I don't know. I'm just going to hold on to them. It's not like it's an unprofitable dumpster fire of a business, right? United Health. So it is what it is. You live and you learn. All right, let's go ahead and jump on over to Wednesday. It looks like Tuesday. It's a bunch of names that I've never heard of, so I can't really add commentary if I don't know who you are. So Wednesday, we got Cisco. Believe it or not, they're in my portfolio, right? Dividend compounders with cheese. I invested into them a while ago because when I used to work in corporate, all of our stuff was secured by Cisco. Logging in, the Wi-Fi. I'm not an IT guy. So I was like, you know what? I'll look into them. Once I looked into them, I was like, all right, well, I'll just buy it. And come to find out, they've been having a tailwind because of the data center boom in gold rush. I didn't know that they were going to benefit from the data center movement when I invested into them because that was a while ago, right? But Cisco for me has just been a buy and hold. I don't really plan on selling out of them anytime soon. Even if they crash after their earnings, I'll probably just hang on. When it comes to like the physical IT infrastructure, I'm not going to say that I'm bullish, but I definitely think it has a place to stay in our society. So I'll just hang on to them. Not the best company in the world, but I'm not angry at them either. So it's like no point of just trimming or selling out of them if I'm not having negative feelings about them, right? I don't want to just sell to sell. Doesn't make any sense. We've also got McDonald's. I only have one share of McDonald's. So to be honest with you, I don't even need to tune into them. McDonald's is just one of those blue chip household companies that no matter what happens, over the grand scheme of things, they always increase up into the right. They're not exactly the best company, right? But they always seem to find a way to keep increasing in their share price appreciation. So I'm just going to hang on to my one share. I think it's a good company, right? Not the best. You always have to associate McDonald's as having a real estate portfolio of some of the most expensive buildings and land in the world. Paris, when we think about London, when we think about New York City, they own that McDonald's. And then they collect rent money from the franchisees that are running the operations. I really like them. But thinking about doubling down or buying more shares, probably not unless there's a big or a major pullback. I think McDonald's is one of those companies where you could just buy into, check your portfolio 10 years later, and it'll be up in the green by a significant amount. You know what I'm saying? We have T-Mobile. Dude, I've been working on a video, T-Mobile versus AT&T versus Verizon for the longest time, and I just keep putting it on the back burner. But it's a company that I do want to circle back on and talk about eventually. So I don't want to say too much in this video because I think maybe this week I'll find a time to just get it done. I'll film it and upload it. We got Motorola Solutions. I mean, obviously, they used to make the Motorola Razr, which when I was in high school, that was a big deal. Everybody had a Motorola Razr. Now, I think they make a lot of the patents for RF, like radio frequency waves. Really important for communications, but also in defense, like for warfare. So, kind of an interesting company. Not really interested in them. But then there's a holding that's reporting on Wednesday. Come to find out, Waste Connections. I'm invested into them. I picked up shares of them when they were $162.50 or something like that, when they went on their little dip at the beginning of this year. For me, I think waste disposal and recycling and having someone to make your trash get out of your line of sight twice or 3 times a week, that's a business that I am personally bullish on. It's something that you can buy and hold, and you don't really have to worry. Unless they run into a major scandal or their CEO goes on record by saying something ridiculous or diabolical, then of course I'd sell out of them before the share price tanks. But if it's business as usual, I mean, I'm just going to hang on to them. I think with the current administration, there's not as much incentives for recycling, and that's why they're taking a hit. And I think one more thing, like a landfill, I think out in California closed. So that's why their top line is going to take a hit, but the market's already anticipating that, right? And that's why they were pricing that in. They've been dropping from like 200 a share, roughly 200 a share, down to 169. So it's not like it's going to catch them out of surprise. Isn't it crazy how much can change in terms of like priorities from administration to administration? Like with the last one, dude, I was eyeballing EVs all day, knowing full well I live in Japan and I can't buy an EV because of the EV tax credit. And I was like, it might be really cool to drive a Tesla. And then come to find out, with the transition with the new administration, there's no such thing. They don't care about EVs. In fact, they don't want you to drive EVs. So now I don't think I'll buy an EV. So it's crazy how much things can change. But I guess that's life, right? And we got Kraft Heinz. I don't have much to say about them. I think out of the food CPG stocks, they're probably the worst. I stand on that hill. Not a good one. And let's see, is there another one? Tyler Technologies. Can we talk about them for a little bit? So they're also a part of the software stocks sell-off. Very similar business model to Roper Technologies. They make software for all of the unsexy industries, right? Like government, municipalities, for public transportation systems, for law firms, and stuff like that. They don't really cater towards the sexy niche AI stuff, but they're making the software for the people where they literally don't have another option except perhaps Roper Technologies. But I think between the two of them, I would rather go with Roper. Reason being, like, I know they're on a pretty big sell-off. Reason being is that Tyler does not pay a dividend, whereas Roper does. And they're pretty much doing the exact same thing, except Roper makes software for the water utility stocks. I like water utility stocks, so that's one value add of Roper, but also they pay a pretty juicy dividend. So all else being equal, I would personally go with Roper, but Tyler Technologies I think is pretty solid. I think it's one of those companies where you either believe that vibe coding is going to make them obsolete, or you understand that governments are very slow with a lot of red tape, and they're not just going to jump ship to a vibe coding software to replace all of the stuff that keeps their network up and running, right? Like when you think about a courtroom, a court system, or when you think about the various law enforcement departments. Why did I say that? I mean like police stations. When you're using Tyler Technology software, I mean, it's not gonna, I think what I'm trying to say is they have a very sticky economic mode. Like once their software is ingrained into your company's organization, you're not really going to want to jump ship unless the value proposition of vibe coding is too good to pass up, which we don't really know how good it is until it becomes more popular. Confluence, is there any? Watts Water Technologies, this is another one that's in the business of software for the water meters and water utility stocks. Not interested in them. I think they're a little too expensive because I think an alternative that I've been eyeballing is Badger Meter, ticker symbol BMI. So, yeah, Pilgrim's Pride. I think they make poultry, right? Like chicken and turkey. Very similar to Tyson Foods, except they're more... No, actually, they're the exact same thing at the end of the day, right? Poultry. Yeah. Is there any? Oh yeah, there's Triple N REIT. Exact same business model as Agree Realty. Okay, so if I had to categorize the REIT space, I would say Realty Income Corporation is a clear S. And then Agree Realty is like an A+, and then Triple N would be like a B+, if I had to break it down. And then Stag Industrial, I think that's a REIT that rents out warehouses. Let me see, because it's been a while since I looked into them. Yeah, industrial properties, another way of saying like factory, space, warehouses. They should be thriving, right? I think this is also a really good REIT. Stag. Yeah, pretty solid. If you're invested into them, good for you. I used to be invested into them in 2019 when I had a completely diversified portfolio. They were actually my REIT holding, funny enough. There's New Market. They're in the business of refining. I think they're a downstream oil and gas player. Like they make the most random petroleum and lubricants for engines and stuff like that. Check out their freaking total return, 45,000%. The reason why I mentioned them is because my buddy that I went to school with, his dad is the CEO of this company. And I remember, I guess one of our other classmates mentioned it to me in passing. And I was like, wait, what? His dad's the CEO of a major, S&P 500 company? Yeah. But what I don't like about New Market is their top line is not really consistent, nor is it really growing in a reliable pace, right? It's been pretty much flat for 10 years, give or take. $2 billion, $2 billion. But I guess the disparity between 2.1 to 2.7 billion is kind of high. So I guess in the grand scheme of things, it's up and to the right, but yeah, it's kind of slow, isn't it? I mean, the dividend profile is juicy beyond belief, right? 12% growth rate. Yeah, it's pretty good. All right, let's go back to Wednesday. We were at New Market. Speaking of Shark Ninja, dude, I was using a, what is that thing called? NutriBullet, whatever. You know the thing where you can blend your smoothie? I drink a smoothie every single day. I'm a huge health nut. And after using it every single day for like 8 years, the motor finally died on me. And so for Christmas, I ended up getting a Shark Ninja blender. Dude, game changer. Like, it was expensive, right? Like, it was like $100 or something like that. But my goodness, is it the best blender that I've ever used in my life. Like, the motor output is like 5 times better than the NutriBullet or whatever the heck it is that I was using. But would I ever want to invest into Shark Ninja? Dude, absolutely not. I mean, I do like their products, but I don't know if that's enough for me to be like, dude, sign me up. Let me invest into Shark Ninja. So, I don't know. And also on Wednesday, I wanted to talk about this one, which is another utility, right? Oh, there it is. Northwestern Energy Group, ticker symbol NWE. Take a look at what's happening to them right now. Past 1 year, 26% into the green. And this is a utility company that's merging with Black Hills Energy sometime later this year. I forgot when. I think it's like in the middle of the year or towards the end of the year, whatever. But after that merger, it's going to make them the biggest dog in Wyoming, South Dakota, Montana, and some other very cold states in the Midwest. And they're doubling down right now on trying to get more data centers opened up in those states. So hopefully that happens. If not, I mean, it's whatever. They're crushing it. And I think their stock price has been soaring because of the merger announcement. So if you didn't buy into them at $50, I think at $68 might be a little too late. But I guess it's a good time for us to look at Black Hills as well, right? So as of right now, at the time of filming this video, they've convinced Meta and Microsoft to open up data centers in their territory. But I think they're trying to get a contract with Google going. So we'll see whether or not that's going to pan out. Maybe they'll shed some light on the earnings call. Probably not. I feel like the earnings call is going to be 90% dedicated towards the acquisition, how things are going to play out. But how is Yeah, I think the ship has sailed with Black Hills. They're at their 1-year high at this point. Yeah, it's too late, friends and family. Let's just go to Thursday. How upsetting, right? I'm trying to jump into a freaking utility and they're all near their 1-year highs, right? But hopefully Duke Energy can dip. Because out of this entire week of utilities, that's the one that I truly want to buy into, if given the option. We've also got Applied Materials. I think this ship has sailed. Like, if you're trying to buy into them at the highest price they've ever been in their publicly traded history, I just have no words. There's Arista Networks, Southern Copper. So let's talk about Anheuser-Busch. This is a company that actually had an offer to join their strategy team, and I declined. And I'm kind of glad I didn't join them for a whole plethora of reasons. But I think the one statement that I want to say right now, when it comes to the alcoholic industry, dude, they're suffering right now because they're finding out that people under the age of 30, they're drinking less than ever before. And it's evidenced by their revenue just dropping, right? As the younger kids are getting older and older, they're not gravitating towards drinking as much as the millennials or Gen X, for example. So unless their business model changes or people start drinking more, the alcoholic space, I'm bearish. But my gosh, for the past 1 year, they've been crushing 54% into the green. That's a little surprising, to be honest with you. So if you take a look at some of their other, I don't know, let's look at the Boston Beer Company, ticker symbol SAM. Wow, they're actually they're flat now. What's happening? Why is the alcohol? Oh my goodness gracious. Past 5 years, the Boston Beer Company, negative 78%. See, that's more of what I was expecting. But to see their valuation year to date, 26%. Wait, what's happening to the alcoholic space? Because based on my market research, alcohol is trending downwards. So why are the stock prices crushing right now, especially with the financials declining as well? Let me see if that's something that's happening across the board. Anheuser, Constellation Brands, I think this is another one, right? Aren't they the parent company of like Modelo? I can't remember. Yeah, Modelo. Is there any others that I would recognize? I'm not a drinker, so... Oh yeah, Corona and Modelo. Let's see what's happening to them. Yeah, revenue decline 7.8%, but I also think it's because of the tariffs with their products, I guess, costing more to export into Canada and other places. I'm guessing people are deciding to buy less. So, there we go. Constellation Brands, 5-year low right now. My gosh, that dip of the century. Dividend profile is okay. It's not good. But, I don't know. I guess that's a very long-winded way to say I'm not interested in the alcoholic industry whatsoever. I'd rather buy into the utilities, which is what I'm trying to do right now. But, let's see. We got Airbnb. If if I had to pick between Airbnb and Uber, they're exactly the same business model, right? They don't own the assets of the buildings or the cars. They just allow people to use them as a platform as 1099 employees to do all of the heavy lifting for them. I'd rather go with Uber, but I don't know. Then again, Airbnb, they also, I don't know, because I feel like 5 or 10 years ago, whenever I was, so one thing about me is in 2016, I actually backpacked around the world. That was a moment of awakening, right? Once I experienced life outside of the US, in Southeast Asia, in other parts of my comfort zone, it made me realize there was a lot more to life than what I had previously thought. And anyways, back in those times, Airbnb was the move, right? They were usually like 30-40% cheaper than a hotel. But at this point, if you go to an Airbnb, you pay more, because not only do you pay for the night, whatever the accommodation agreement is, you also have to pay the cleaning fee, the key fee, and then when you get there, you also have to do chores. You have to do this, you have to cut the grass, you got to do the dishes, and it's like, dude, what in the hemoglobin happened here? Whereas with a hotel, you still get treated like a guest that's on vacation instead of someone that's scrubbing a toilet in the middle of the night, so you don't get charged for being a bad tenant. So with Airbnb, I think based on the landscape of what is happening to them, I think they need to crack down on all of the people that are offering their homes for rent on Airbnb. Instead of like laying down 20 rules you need to do before you can check out, they need to make them take a chill pill. I think it's getting a little outrageous here. But my gosh, if you're investing into Airbnb, goodness gracious, I mean, put me on, right? I mean, the numbers, actually, let's take a look at the numbers really quickly. Gross sales, pretty good. I mean, it's slowing down. Break it down on a quarterly basis, it's slowing down, but it's still double digits. EPS looking pretty good. Jump on over to their balance sheet. $11 billion of cash on hand. That is ridiculous. Just absolutely ridiculous. Total debt, cash heavy. Okay. Balance sheet checks out. Free cash flow is probably going to be bonkers. I already know. Yeah, $4.5 billion of free cash flow. Take a look at their take a look at their KPIs. North America revenue growth is 3%. Not good. Europe seems to be crushing, 11% growth. Asia Pacific is slowing down, but it's crushing. Okay. I mean, all that to say, not really interested in Airbnb, especially with so many companies on clearance and on discount right now. I feel like I don't have to entertain Airbnb, right? Okay, there's a utility. American Electric Power, ticker symbol AEP. They operate one of the nation's biggest transmission grids. I think it ranges from like Texas to Ohio. They're basically in the business of moving power from one place to another, if that helps you to visualize what they do. Take a look at 1 year. Darn it, why are they all near their 1 year highs? It's making it harder for me to find value. Well, I mean, if they fall off a cliff after their earnings, that could be my opportunity. But this is a really good one. I take back what I said about Duke Energy. I think all else being equal, this is the one that I would want to buy into. Dividend profile looks good as well. I don't want to be selfish here. I kind of hope they drop off, but if they don't, whatever. But I think Duke Energy will probably move the entire utility sector with them. Like if their earnings is absolutely bullish, then I think the markets are going to price in bullish news from the other utility players, right? Because they're all doing the same thing. They're providing power to residential and commercial buildings, but also, more importantly, to the hyperscalers data centers that are power hungry. And that's why I'm interested in them, if you were wondering. Jump back over to Thursday. Coinbase. I I read somewhere that Coinbase is selling off. Let me see if that's the case. Yeah, that is the case. My gosh. I forgot what they do. Isn't it like an exchange for crypto and everything else like that? Yeah, a brokerage platform for crypto. Jeez, man, the growth in their nut. But what happened here? Can anyone add some context of what happened? In 2021, their revenue was $7.8 billion, dropped off a cliff by 60% year over year, and then it's slowly recovering, and now it's $7.3 billion. Like, how and why was their revenue so high? I wonder if it's because in 2021 a lot of people were interested in Bitcoin. Perhaps that's the reason. I'm not really sure. But Coinbase, not really interested in. Wow, speak of them. Didn't we just talk about PCG? They're reporting their earnings on Thursday. Definitely a utility that I don't want to go anywhere near, right? Oh, there's another one right here. EverSource Energy, ticker symbol ES. It's the biggest utility player in New England. Between you and me, I'm personally not bullish about data center development in places like Connecticut and New Hampshire because I think those are very high tax burden states. And I think the data center players, they don't really want to go in high tax states based on my understanding. So I think they would rather go to places like Virginia, Texas, Nevada, Washington. But let me see. Even them, they're also near their 1-year high. My gosh, guys. But in the past 5 years, not looking too spectacular. Okay, so out of the utilities that we assessed so far, they have the highest dividend yield at 4.6%. Their numbers, kind of inconsistent. I think something happened here. It can't fall off that hard. $12.2 billion down to $11.9 billion. I'm assuming they sold off a portion of their territory to a competitor or something like that. Actually, that's really sketchy. 2023 and 2024, $11.9 billion flat. So I'm guessing maybe it was like a judge or jurisdiction that's like, hey, you can't charge anymore for power and the electricity bills for these families under this income bracket or whatever. I don't know. I'm just talking out of my butt. But for their revenue to stay flat like that, something fishy happened. Anyways, let's see. Anything else on... Oh yeah, Zoetis is reporting. Obviously, if you watched my portfolio reveal, you would know that I'm invested into them. They're basically in the business of making vaccines and drugs for cats, dogs, hamsters, and livestock. And right now, they're going through a huge scandal with one of their, I think it was like a rabies vaccine or something like that, that's causing health consequences that may or may not be directly linked to their vaccine. So, consequently, they sold off, right? This is a company prior to that scandal. They were roughly like $200. They sold off, and once I saw they sold off, I hate the pharmaceuticals, don't get me wrong, but I was like, dude, this is too good of a valuation to not jump in. So, lo and behold, I did it. I was like, whatever, YOLO. And I'm in the green by a pretty good amount. Hopefully, this earnings report, they say something positive and it pops to like 130, 140. That would be even better. And then as we resume, looking at Thursday, we've got Toast. They're basically providing a software one-stop shop for restaurants. Literally only restaurant and restaurant chains. Everything from like inventory, supply chain management, reservations, payment processing, everything you can think of. I listened to a podcast with one of their co-founders. He's an MIT guy, absolutely brilliant. You could take a look at their numbers. It's just bonkers. 25% year over year for their top line. Their EPS, they were unprofitable up until 2024. Take a look at their debt situation on their balance sheet. So they got $1.8 billion of cash on the books. Total debt, friends and family, is $18 million. Literally a cash flush company that does not have debt, in my opinion. At $18 million to that of $1.8 billion of cash, it's no debt. Free cash flow, yeah, $564 million free cash flow, 122% growth year over year. Pretty good company. I bought into them last year and I sold out of them for like a 15-16% profit, but it's definitely a company that I wouldn't mind jumping back into. I think the reason why I think they're selling off is because they're a part of the software stocks sell off. And when you think about all the restaurant chains that are using a Toast kiosk to process all of the orders, the payments, and everything else, I highly doubt they're going to jump ship. I think also, though, with Toast, they trade for a pretty big premium, so it's not cheap by any means, though. So something to be mindful of. DraftKings. Sports gambling and sports betting is getting really popular, isn't it? Personally, I've never done sports gambling. It's not really my thing, but I think for some people, they would rather do gambling or lottery tickets than investing into stocks. Some of us, we do both. Me personally, I would rather just stick to stocks, right? There's also Pinterest. Now, Pinterest is a very interesting company because fundamentally and financially, their numbers are really good, right? Their top line is 16.7% growth year over year, whereas in 2022 and 2023, it was 8% growth and 9% growth. So they're accelerating. And if you take a look at their EPS, they were unprofitable, pretty volatile up until 2024. And now they're flush in cash. Profitability, their margins are in order. Take a look at their free cash flow. $1.1 billion free cash flow. But the thing is, like, who the heck uses Pinterest? Right? And I think a lot of people do to create like lookbooks or for their wedding planning or for interior design of like your future house. There's people that use it, but I'm just not really feeling it. Like financially and fundamentally, it makes sense, but they've been selling off because I think they're making a pretty big pivot and transition into, they're a social media app, by the way. If you have no idea what Pinterest is, if your wife is over the age of 50, she probably has a Pinterest account. It skews heavy towards the female demographic. They're making this pivot into becoming like a shopping affiliate type of business where people can start creating like outfits or food recipes or whatever. You can click it and you can buy it. And like that's their big push right now. And I think a lot of people are starting to be dissatisfied with Pinterest because it's turning into AI slop. Because everywhere you look, it's ads or it's AI slop rather than organic humans custom tailoring an appearance or a feel or atmosphere or a vibe. Instead of that, now it's AI slop that's creating everything. And I think it's rubbing the user base the wrong way. Reason why I looked into them is because I was like, dang, dude, like their valuation, forward trading multiples be at 11 while executing the numbers that they do. I mean, I was interested, but after taking a look at their landscape, and then I hopped on over to like the Pinterest Reddit, people are disgruntled. I'm like, bruh, I don't know, man. Y'all are making way too many drastic moves where you're not going to be who you were a year or two ago. And so you're investing into something that you don't even know what they're going to be, right? I don't think they have evolved into their final form yet. So we have no idea what Pinterest is going to be next year, right? Unless they dial back on the AI slop. Now, here's an insurance player that I personally have on my watch list. Kinsale Capital Group is probably one of the best out there. I would argue probably an A tier, right below Progressive, Berkshire Hathaway. This is a really high quality company, but they are selling off. And for me, I tried to jump in at, personally, I think it was like $350, but I don't know why the buy order didn't execute because they did reach $349. A little disappointing, but when you talk about a company, what's their market cap? $9.6 billion, and their revenue growth being this consistent with double digits year over year since 2015, right? Dude, I get excited when I think about them. However, dividend profile, a 0.1% dividend yield. I know some of you guys are probably triggered, offended. That's hardly a dividend. But need I remind you of NVIDIA? Their dividend yield is like It's like you have to pay NVIDIA money instead of them paying you money. Like that's how small NVIDIA's dividend yield is. Let me just pull it up. Refresh my memory. 0.02%. At that point, don't even pay that dividend. Use that money to buy back some shares, right? With Kinsale, they're growing their dividend by 22% year over year. High quality by all regards. I'm so sorry. Off the top of my head, I cannot remember what caused their steep drop off right there at the end of the year last year. I forgot what happened, but it's because I've been filming for a hot minute now, so my brain's getting a little fried. But anyways, moving on with the video, we got Maple Bear, which this always confuses me. This is the parent company of Instacart. So instead of you having to physically go to a grocery store or to the shopping mall or Costco or whatever, someone else will do it for you. It's kind of like Uber Eats. I mean, it's an interesting business model, but one thing that I'm seeing a trend is that all of the big retailers are keeping it in-house. They don't want people to do Instacart anymore. So Walmart has their own flavor and variety, Target, Amazon. I think Maple Bear, I guess Instacart, it still makes sense for like the smaller grocery chains, but I think everyone's trying to launch their own 1099 employees that are running around delivering stuff on their behalf, because the margins are a lot better if you do it that way. Pretty funny, but I actually did a huge investing thesis for the Instacart during my MBA. It takes me back like 6.5 years ago. Kind of funny. Not a company that I would ever want to invest into. I'll just leave it at that, right? Let's see. Anything else that's crazy on Thursday? If not, we can jump on over to Friday. Enbridge, TC, Collier, Seaboard, Trump Media, Wendy's Company. Can we talk about Wendy's? Funny enough, hold on. Let me show you this first. Past 1 year, 46% into the red. Past 5 years, negative 62% into the red. Forward trading multiples of 9.7. And their gross sales are kind of stagnating, and I'll explain why here in a second. So, low key, after taking a look at Wendy's about like a month ago, I flirted with the idea of whether or not I wanted to jump into them, kind of like a rebound play leading up to this earnings, and then selling if they post positive earnings. I don't think it's a buy and hold, right? However, ultimately, I made the decision not to buy into them. I'm so glad I didn't, because my cost basis would have been like $8.50. Now they're $8.02. I just think it's too risky, right? I think this is a company where if you look at the landscape of hamburgers, I think Shake Shack right now is best in class, bar none. It's trending and it's super hot in China. Like the middle-class Chinese citizens, they can't get enough of Shake Shack. And then I guess we could toss up McDonald's into like second tier in terms of like the best burgers. Obviously, when we talk about taste, that's a whole different conversation, right? In-N-Out, easy. Habit, Grill, easy. And then there's the steak burgers made by Freddy's, which is pretty darn good as well. There's a lot of good tasting burgers, but when it comes to like a business enterprise, whole different ball game. And Wendy's, dude, they're not in the S tier, A tier, B. I think Wendy's is like in the D plus tier. And as of right now, I know they're closing up to 300 underperforming locations, which means they're going to be engineering their revenue to drop in the near future. That way their margins can improve. It's the exact same game plan that Target has. So I don't know about you, but I don't want to buy into Wendy's, right? Because if they sink, it's not a company that I would want to hold on to. It would make my stomach toss and turn knowing that it's low quality. Not a company that will allow you to sleep well at night, especially with their debt to EBITDA being an 8. There's whatever the financial, whatever the fundamental, whatever the metric, it's atrocious. So Wendy's for me, I can't do it. I can't do it. But anyways, I wanted to talk to you about something that's been on my mind before I head out of here, because I don't know. I need to share it with someone, right? And I always call you guys my friends and family. So I came across this post on LinkedIn about 6 years ago when I was doing a lot of recruiting and interviewing for different firms and companies. And the post, it was one of my friends. He was sharing a story about his coworker, and it left quite an impression on me that I still remember it, right? So the coworker, he volunteered for every project. He worked his balls off. He grinded so freaking hard. That way he could retire early at age 46. And I think that's why I paid attention to the post in the beginning, because it said are you pursuing financial independence, retire early? And I was like, wait, what? And then it went into this very sad story, and then I couldn't stop reading at that point, right? His coworker gave everything to his job to maximize his earning potential. That way he could finish early. And he was just always focused on the finish line whenever he reached whatever his portfolio goal was. I don't know, right? It could be like 5 million, 3 million, whatever it was. Well, come to find out, a week later, as soon as he retired, 7 days later, maybe it was like 5 days, he had a freak accident and he passed away. Meaning, his coworker never got the chance to enjoy the life that he had been sacrificing for. And I don't know about you, it hits me hard, right? I'm reminded of, with my friend's coworker, working hard, grinding, planning for the future. I think all of that is nice. Super important, right? You don't want to just be willy-nilly freestyling life, because then when you're like 80 years old, you're going to panic, right? But I also think it's kind of pointless if we don't live in the present tense as well. Like, if all you are is laser focused on your portfolio valuation goal and that's all you care about and prioritize, I feel like you're neglecting everything that's around you right now, all of the beauty that's happening in your life. And if we delay happiness until we cross, some finish line, whatever it is, right? You can fill in that blank. Who's to say that we're ever going to get there? Who's to say that a week later we're going to croak, right? I want to defend myself too. I'm not trying to say you got to throw everything away and be reckless. Okay, screw all of this investing in stocks nonsense. I'm just going to do whatever I want. I'm not saying that either, okay? I think it's wise to keep working hard and chasing goals and all that jazz, but also just use the money that you have to experience life every now and then. Use that money to give it to people that need it more than you. But more importantly, also just enjoy life, right? I watched this Disney Pixar movie the other day. When I say the other day, I mean 6 months ago. Dude, I know it's like a children's movie, but it left me just speechless. It's called Soul, and I won't give any details other than the title, Soul. It basically just talks about the meaning of life. And I still can't believe it's catered for a younger audience, because even as a grown-ass adult, I was like, dude, this thing smacks. And I want to share a poem with you that kind of, I guess, bounces off this whole idea that we're talking about, right? Don't save the good stuff for the funeral. Why ordinary days deserve the good things. One day, someone will open your closet. They'll find the shirt you were saving for the right occasion. They'll run their hands over the fancy dishes you never used. They'll light the candle for you because you never lit it for yourself. And that's when it hits. You weren't living, you were waiting. Waiting for the perfect day, waiting for the perfect version of you, waiting for a moment that never came. That's what saving the good stuff really is. A quiet bet that you'll have more time. But one day, the time runs out. And all those little joys you stored away become relics at a funeral. That's what happens when you keep saying later. Later becomes never. And the things you thought were too special for an ordinary Tuesday, it ended up being props at your farewell. Stop living like you're rehearsing. Stop waiting for some grand permission slip to be happy. This, right here, this breath, this moment is the occasion. Light the candle tonight. Pour the wine on a random Wednesday. Use the plates for takeout if you have to. Wear the shirt to buy groceries. Stop living like life will begin later. Stop treating joy like it has to earn its place. Your happiness isn't meant to sit on a shelf until you're gone. It's meant to breathe with you, laugh with you, spill with you, right here while your heart is still beating. Because here's the brutal truth. Too many of us live like funerals are the only special occasions. Waiting to open the good wine, wear the best clothes, or laugh loud and free. That phrase cracks me up, right? Live, laugh, love. Until the moment when we're no longer here to enjoy any of it. You save your joy for a day that might never come. You hold your happiness hostage, waiting for the right time, the perfect you. But all the while, life slips quietly past, and those fancy dishes gather dust, the candle wick hardens, and the special shirt folds deeper into darkness. Because life does not promise a tomorrow, but it always offers a right now. So don't save the good stuff for the funeral. And I think it's a good reminder for some of us who are so freaking focused on the end goal that, I don't know, we accidentally ignore life as it's happening. Okay? So having said that, I'm going to be taking a day off tomorrow, because the Super Bowl is happening, and if you're not an American, it's basically the World Cup on steroids. It's the biggest marketing, advertising opportunity in the U.S. American football, the two best teams from the NFC and the AFC, they face off to get the championship title. It's a Super Bowl. Really important. And lucky for me, the team that I support, the Seattle Seahawks, they're in it. I have a good feeling that we're going to win it, but when it comes to the Super Bowl, you just never know. The players might get a bad night of sleep, have an argument with their lady the night prior, or have an illness, whatever it is, and you can lose. On paper, I do think the Seahawks are going to win, but again, I don't know. Now, having said that, hey, I appreciate you guys for spending the time with me. I love you. Stay safe. Good luck in the stock market, and I will talk to you really soon.